I was going to start off with Quindell, because obviously that's one of the stocks at the moment. I'll try and get some sort of charting, some of my indicators on there. I think it's a good illustration of some of the pluses and minuses of trading technically. The end bit of the situation here with the collapse. This was, as I've said to people over this afternoon, over the day, a classic bull trap with a break of the February 44 pence high. We went a little bit higher than that, a penny or two above that, and then the fall. And in fact, according to a technical rule, you could actually sell on the day you closed back below 44 pence, which would have been probably 2 or 3 weeks ago. That was well before the Gotham City research note pulled the plug on the company, and it wasn't actually late. It wasn't what people normally say about technical analysis, that it's trend following. It was actually a great reversal signal well before an event happened. So whether that was a coincidence or whatever it was a great triumph for technical analysis. I have to say, I myself saw the signal, but was looking for a buy on the dip towards the 50-day moving average around 37 pence. And there was a slight rebound from that, but then obviously the note came through. But if you want evidence that charting or TA can be ahead of the market, that is probably one of the best examples that you have in the near term. The other point to note is that as my good friend Evil Knievel found out, you can be right about a company for a long time, in the sense that you say you're bearish about it, or you think that the rally doesn't make any sense, or the £2 billion valuation is over the top. But you could have been going short here and then getting hit when the stock rallied to 18 pence, or gone short here and got hit here as well. So the timing, the advantage of timing, or the advantage of TA, is that it should help you with timing, and also, I suppose, a risk reward in terms of deciding whether, I'm going to sell against this high here with a 2 or 3 pence stop loss. I'm hoping that if the company is as bad as I think as it is on a fundamental basis, there would be a decent downside, maybe to 32 pence or something like that. Obviously, this situation now has sort of set everything in a sort of panic mode. The current situation here at the moment is that there is an uptrend line running from April last year through the 17 pence low that we had last week. 17 pence was also the resistance area on the way up. So in the first instance, you would be a buyer on a technical basis. You would be a buyer down to 17 pence. If I see the stock below that now, I would start to get worried. At the moment, it's a bargain hunting opportunity, not the end of the line. But as I said, below 17 pence would indicate trouble. At the moment, actually, all the shares have done is actually just sort of retraced what was let's say, a ridiculously sharp rally over December to January. So Quindell, actually a triumph for charting, obviously not a great triumph for most people who are long of the stock and thought that it was the next FTSE 100 prospect. It may still be that, but at the moment we've got to pause there. The other point to know, maybe another point to note on an optimistic front, is that we had an even worse. I think the decline from 12p to 5p or 6p last year was, in a way, much worse than the move we've had now, and we are obviously much higher than that level before. So you could say, I don't particularly want to give the company the benefit of the doubt, but you could say that this is just a situation where overall the shares went up too fast, too far, rather than necessarily the doomsday or the doomster scenario regarding the company. Any other charts that I can look at least in a basic way?
Pacific Ethanol, PEIX.
I don't know whether we're going to get that on here, but PEIX. Pacific Ethanol. I don't know if it's going to do. Is that right?
Yeah, PEIX.
Good thing about this chart, apart from obviously the massive sort of the bear trap rebound we had, the unfilled gap to the upside, through $11 at the end of February. Unfilled gaps always indicate great momentum, great force behind a move. The inability of a stock or market to fill that gap after 2 or 3 or more attempts means that you're on guard for a move to the upside. In this case, really, you'd say that above the $13 area, back up to $18 as a minimum, while that gap remains unfilled. So it's looking like a very strong position. This is probably 3/4 of the way up on a move towards, say, $22 or $23, something like that. But stop loss there, no lower than 13, and it's a what I call a bull flag gap situation, which is one of the best you can have. It reminds me a bit of probably the situation. Actually, probably the situation that I remember amongst the popular stocks is Lloyds, where there was a gap up here in July through 70 pence, and the shares have tried to fill that gap and then failed. The low was around 60, well, I think 70 pence. So we failed to fill that gap by a penny. And so while that's the case, I would be backing a new leg to the upside and to retest the best levels there. So gaps are always useful, either as stop losses or to indicate power behind a move. So let's say in this situation, Lloyds looks like it's still a buy even after the retracement. Sorry, and AUM. I'll do both of them. I'll do HSBC first. That's, I mean, you're looking to, like in the case of Lloyds, if you didn't like Lloyds at 75, 80 pence, you'd be looking to buy at the floor of that gap, which is 68.9 pence, to go long again. That's what you would do in the first instance. It's a bit like with Quindell, the 200-day moving average is at 22 pence. That would be one of the places you'd be looking to buy, because there's normally a reaction from the 200-day line, and there's normally a reaction from either previous resistance or the floor of a gap. So those are the rules of, you know, the charting rules. It's a bit like this situation here with HSBC. There was the gap down there, say it's 758, the top of the gap. The shares gap down there, and then they went up to 761, filled the gap, and gave you a sell opportunity. So all this time you could have been waiting in the shadows with a sell order at 758, looking for that gap to be filled. And you would do that in the first instance, even if, let's just say, you thought, you know, the market would have thought it was going to keep on going. But the first thing to do here is to go short of the gap, and then, if obviously that fails, then you as an end of day close, say above 758, then you go the other way. But the technical rule there is to sell, to wait for a fill of that gap. And you can see very often it's a very good signal, and these are very good signals here. The current situation. We've got a gap to the downside. I would follow that at the moment and look for at least a retest of 590. Stop loss on the sell would be, you know, 615, something like that. But at the moment, it looks like, it looks like a negative situation, especially with the resistance coming in basically at former support in February. That is a bearish setup, especially with the gap coming in through there. So. At the moment, near-term sell on HSBC, on AUM. Sorry? N-U-M. Back, well, I can't draw any trend lines here today, but we're back towards the trend line support from April last year through around 295. I'm not sure I would want to give the benefit of the doubt to this situation, really. Looks to me as though we've got a sort of triple top coming in there and a bear trap. This was a bull trap through this high here at 316, something like that. I'd only go long of this again if it broke back above this high here. So that's the view on that. So it looks as though there's a risk of a breakdown of the. I don't know exactly where the trend line is here, but a break of the uptrend. And at the very least, I'll be waiting for a break of that high here. It's a bit of sort of head and shoulder situation. So let's assume the right-hand shoulder is around 315, 320, and you want to break that area before going long again.
HL.
What a pity. This is actually it reminds me a bit of the Quindell double top, in the sense that, well, Quindell, there was a higher top here, there was a higher retest here, but it's like you've got, the sort of, it's like a rabbit's ears type of formation here, the double top, the left and the right side. The clear necklines support broken. You've had a gap here as well, unfilled gap to the downside through 1310, something like that. So there is momentum behind this move to the downside. You wouldn't give it the benefit of the doubt because of that gap. And even though there's some support coming in through here, I would be looking for this to go back to this gap here, in fact. So I'd be pretty negative on it. We've already had 2 failures here around 1250, well below the £13 level as well, so that's another negative, new resistance coming in below old support. So I'm looking for that gap to be filled. If you want to buy it at £10.20, maybe that's a different situation. But this is a major reversal formation, and the market really sort of, I wouldn't say wrong-footed, but the market was really looking for this to keep going. So the rug has been pulled from underneath this stock, and the gap shows that the rug has been pulled from underneath this stock. So £10.20 or so on that. Sorry? Yeah. Oh, Rio. Okay. Blinks, as I was saying to somebody today, was a sort of a dress rehearsal for the Quindell situation. American sabotage, I think, is probably about the right way of looking at it. Great business model for the bears, I think, on that one. Waiting for the next, see who's next. Here we've got, again, that sort of it's like as I said, I was trying to say the rabbit ear formation, but the double top there. Neckline, very similar to Hargreaves Lansdowne as well. We've had the neckline there, 192, something like that, and then multiple attempts at breaking back above previous resistance. Couldn't do it, so highs there, 188. Failure below previous support as new resistance. And in fact, I mean, the way it's gone down there, I mean, let's say you actually would have made, well, it's a point to note, you would have made money buying the gap if you got filled. There would have been a move from, say, 170 to 188. But then with the break below the gap, we've just totally tumbled. We totally tumbled after that. Current situation, I would basically still be looking at further downside, just because, again, we've got support there around 90p, new resistance around below 90p. So it looks like another negatives consolidation. Horrible bull trap here ahead of Mr. Edelman's appearance in the UK, and it just doesn't look good at all. The only positive, I suppose, would be that the low in January was 85p. If we can hold above that level and make a higher low above there, then I would start to change my mind. Just sort of say, well, maybe there's a bear trap below that 90p support from last year. But at the moment, doesn't look like it's worth, with that consolidation below previous support, there's no point trying to go against the tide at this stage. It's better to pay either a bit more or not get involved at all. Rio. Well, it was a bit of a mess, obviously. I sort of see an uptrend line here with the support running through £32. Might go with that, but really, I would avoid it. I would avoid it. I just don't see a clear pattern here. This is not helpful. The unfilled gap to the downside and the failure to fill to that gap is a big negative. You could buy down to £32, but if it breaks that, then it's not looking good. But the main positive here is so messy that it's not really going to go anywhere in that sort of way. Comms and
Nikkei.
Okay, I don't know if I'll be able to do the Nikkei.
Jim mentioned Rio's being as
being a
long term.
yeah, well, I was hedging my bets, so obviously I don't want to go against Jim Mellon's fundamental analysis. As I said, I think if you're keen on buying it towards £32, would be the level to do so. But the whole point of this is the timing issue, and also it's like with Quindell. Evil knew Quindell was in trouble from 10p, and let's say he's made his money now, but obviously he's a year out. And it's a matter of getting the timing right. I think with Rio, the whole point here is that you're trying to be, or this type of trading, you're trying to be in the market as little as possible, and just from the time you go in, that's where the share price moves is in the direction you want it to move. So that's my sort of goal in these matters. But from what I've been saying already, nobody likes that gap down there. There is support lower down, but I wouldn't have a strong opinion either way. And what I've learnt in my business is that if you don't have a strong view, it's better just to say stand aside. Next one was it? Comms, yeah. Here we have a sort of it's another sort of reversal situation. This is the neckline around 7p. We just had a failure at 7p over the course of April. I wouldn't really be looking to go long of this unless it broke and stayed above 7p again. I just don't think there's any point in, given that the upside is 11, missing out on the first half p or penny is probably worthwhile, given the way that this could still go back to 4.5, 5p. Shy. I'll try and get the Nikkei in a minute. Basically, trend line from April last year running through £28.50, which I saw at the time, before even the Astra deal came through and pushed the price up. Here you see what I mean about gaps, that you got that momentum there, and you could have bought even after the gap and still made money. I think from what I see normally, you can actually just follow. Most of the time, you follow gaps with a sort of okay stop loss, nothing too big. You will make money, and it's a very easy way to trade. And the fact that it's a very easy way to trade is actually probably the best thing about it, even if it's only makes you money 60% of the time, because the money management will do the trick there. Here you could have gone long the day after the gap, 31.50, something like that, and you'd be sitting quite pretty now. I'd be looking for a target towards 36, 37 pounds, drawing a resistance line here, and going up to that sort of level. Stop loss at this point, somewhere around this last peak from March, 31.50, 31.60. So the pharmaceuticals, I thought Shire would be the company to be bid for, not Astra. But they've all been sleeping giants for far too long, and I think they'll be re-rated in a positive way. Also, they are defensive, and that might be handy given the Ukrainian backdrop, which looks like it's a total disaster. So that's that one. I'll see if I can get the Nikkei. I don't know if that's the... No, it's not. Nope. I'll put my computer on, which actually does work. But if afterwards, if people want to go through things on with proper sort of.
How about dollar yen?
I don't know if this is doing currency actually. I don't know if it's going to do this. I don't know what I don't know. Does anybody use? Oh, this is working. Wow. There is a trend line here from June last year. I'm not quite sure whether the dollar yen is quite the big buy that we're led to believe. There is a bit of a pause in the effect of Abenomics at the moment. Clearly, 101 is the support zone, It's sort of good that we bounced off September resistance just below that level in February. So you've got to give it the benefit of the doubt to go back up again. But it's not the explosive move that it should have been. Basically, we should have gone from here and gone straight up in that way. Not all this stuff here is not really what you would expect, given what the Japanese are supposed to be doing and given how beneficial the Abenomics policy is, or supposed to be. So above 101, 105, but that's not really, it's not I'm not happy with that.
So you want to try
TOKY for Nikkei. TOKY.
Okay. No, it doesn't seem like that. So we just have to go for stocks, actually. Sorry?
Zach, 2 more minutes.
Okay. Hopefully this is well, the good thing about this is that we have support. You're probably starting to get the picture of how it works. Support coming in well above the previous August resistance, 1480, 1470. New highs around 1580, 1590. While that's the case, we're assuming this is a positive consolidation and going back up again, back towards 1850. So the rally's still very much in progress there on a simple charting basis. Obviously, it's become very volatile because of such great gains recently, but still bullish on that. The rule about buying towards the gap is the one that I go for there, wherever that gap is, 1520, 1530. Well, if you're long of it, there's a risk it will go back down to that level. If you're not in it, you'd be looking to buy that gap. But this is a nasty, this is a nasty reversal. It could be the end of the rally. So if this is, you buy here first, but you would have your stop loss quite tight on that, just in case it's the end of the line on that. But the opportunity here is to buy towards that level there, the bottom of that November gap.
Thornton, THT.
Who?
Thornton's.
I'll do that. Let's do Man Group because I like that one. Man Group was. Have they got the gap here? I can't see it now actually. The current situation: 2 unfilled gaps to the upside. You could have bought at the top gap there around 97, 98. We filled that gap, and now we'd be looking for a retest of 108, 109 again. So it's a gap fill rebound on that one. Yeah, the big move though here would come on a break of 110, where I would expect it to go all the way back to 130. So at the moment, dips to 97 are worth buying into. On Thornton's, call the stock up from well below these levels. Actually, I can't remember how long.
This will have to be last one.
Yeah, okay. I call the stock up from this area here around 35. So that worked well on the basis of new support coming in above old resistance. I wouldn't now really be looking to buy any more expensively than £1.30. That looks to be the floor of this formation, just in case we're topping out. So dips towards 130 to buy into for a final push towards 160, 170.
There's a change of strategy coming through.
Okay. All right. Thanks a lot.